session wherein I will be talking about the basics or the what is going on in the GST front at present, including the basics of GST. So all of you know that recently you might have heard in the newspaper that the GST collection, monthly collection has gone to around 1,75,000 crores of rupees. The government is getting a lot of money from the GST collections, and the government is looking at various other areas where it can collect more and more revenue from the businesses. So all this we are going to discuss in today's class. Now I will share a PPT with you. If you find it visible, kindly confirm me.
Yes, sir, it's visible.
Okay, fine. Now, the Goods and Services Tax Act, as you all know, it came into existence since 2017, July 1st. So July 1st being a very auspicious day for the government, as it has introduced a new law and has taken out a number of other laws, indirect taxes from the taxing statutes. The GST, the name itself indicates that it is a tax on goods and services. Before introduction of the GST law, the tax was separately being levied on the sale of goods, and also the tax was separately levied on the services. There were two separate departments which were levying the taxes on the sale of goods and services. Now, the sale of goods and sale of services has been merged into one single law called as Goods and Services Tax Law. Now, the basic thing is the tax is levied on a supply of goods or services. The word supply is a very wide, it has a very wide meaning, wherein it includes the sale of the goods, the sale of services, exchange of goods, exchange of services, then a relinquishment of something. It's a wide enough definition for the supply of the services. Under the GST law, what is taxable is a supply. Once a particular transaction fits into the definition of the supply, the person who is carrying out that particular transaction should pay the GST. This is a very important change when compared to the old laws. Then the goods or services should have been transferred to another person, either through sale or by other modes for a consideration. So, in the earlier laws, there were so many provisions which said that, say, for example, I'll give you an example. Mr. A is selling a product for 100 rupees to Mr. B, whereas the market price of the product is 500. So, in the olden law, if the market price was more than the transaction value, then the government was levying a tax on the market value of the product. In my example, the market value was 500, whereas the actual transaction value is only 100 rupees. So the government was levying tax on 500 rupees, not on the actual transaction value of 100 rupees. However, under the GST law, the shift has been changed to the transaction value. The tax is levied on the consideration received for transfer of the goods or services by me to another person. The same example, if I sell a product for 100 rupees, in spite the market value of the product is 500 rupees, I am liable to discharge a tax only on 100 rupees and not on the 500
No.
rupees as it was being done in the
Oh,
earlier period. This is a major difference between the
design.
old law and the new law. However,
Ala itu gari.
there are certain restrictions wherein if the transaction is between the related parties. Say, for example, I am selling the goods to my brother. He is my relative. So, in the GST law, there is a definition for who are the related persons. So, my brother, my family members are one of those related parties. Now, in the case of a family member, say, for example, to my brother, I sell a product, the market value of which is 500 rupees. I sell it to my brother at 100 rupees. Now the GST is levied on market value of 500 rupees and not on the actual sale consideration of 100 rupees, except for the exceptions under the law with respect to transactions with related parties and distinct persons. There are two categories of people. One is related party and the other one is distinct person. Now, related party means there is a definition, my partner, my brother, my sister, my company where I am a director, all those parties are related parties, whereas distinct person is the sale of the goods or services by me to me is nothing but a distinct person. Now, you may ask a question, how I can sell the goods and services to me? So, the GST law says that if you have one registration in Karnataka and you have another registration in Tamil Nadu, so you have two registrations under the GST law, one in Karnataka and another one is in Tamil Nadu. The GST law requires you to get registration in each and every state where you carry out the business. So, just imagine the State Bank of India, which has got businesses in almost all the states, they will be having the total number of registrations under the GST law equal to the number of states and union territories in our country. So, the State Bank of India of Karnataka is a distinct person from the State Bank of India of Tamil Nadu. Therefore, the transaction between the State Bank of India and the State Bank of India of Karnataka and Tamil Nadu will be liable to be charged GST, and it is on the market price of the goods and products. Even if a goods or service is rendered to my distinct person at zero amount, because the State Bank of India is same. Even then, the dealer, that is State Bank of India, has to pay tax on the fair value of the transaction carried out. Then the third point what I want to provide is the supply should be made in the course of furtherance of business. So the supply should be in the course of your business, or it should be in the course of furtherance of your business. So here there are two concepts. The supply is made in the course of business and supply is made for furthering your business. These are the two separate the concepts under the GST law. Now, all these transactions are liable to the GST. Then supply should be made by a taxable person. So it never says the supply should be made by a registered person. The wording used is a taxable person. Who is a taxable person? We will see in the next part of my presentation. So the GST is levied when the supply is made by a taxable person to another person. Then the supply should be a taxable supply. All of you know that in the case of vegetables and milk, there is no GST leviable. It is exempt from tax. It is not a taxable supply. Now, if a particular person is carrying on only the vegetable business or supply of milk, he need not pay any GST on that. He is not required to get registration. It is not a taxable supply. And also, you know that the petrol and diesel, then alcoholic liquor, these are the not taxable supplies. Therefore, the GST law is not applicable in respect of these particular products. Then supply should be made within a taxable territory. The GST can be levied only when the supply is made within the taxable territory. For the purpose of GST Act 2017, taxable territory means the territory of India. So, if the supply is made within India, it is called as the supply is made in the taxable territory of India. Therefore, you are liable to pay the GST. Here, one point should be noted when there are two kinds of transactions. One is intrastate transaction, intrastate supply of goods and services, then interstate supply of goods and services. When a particular dealer sells goods or services to another dealer who is also in the same state, it is called as intrastate supply of the goods and services. However, where a particular taxable person sells goods or services to another person who is in another state, it is an interstate supply of goods and services. Under the GST law, both intrastate supply as well as interstate supply are liable for levy of tax under the GST law. However, in the case of export of the goods, it is deemed that it is an interstate supply. Therefore, in the case of export of the goods, you have to discharge the GST liability on the value of the goods or services you exported outside India. However, if you want to transact with a customer outside India without payment of the GST, you have to undergo a particular process which is called as giving the guarantee to the government or undertaking the letter of undertaking, giving the letter of undertaking to the government. If you follow this procedure, the exports can be done without payment of the tax, with the condition that the proceeds of the sale of goods and services will be brought to India in convertible foreign exchange within the period allowed by the Reserve Bank of India. Therefore, all the transactions, whether you do it inside India or outside India, are covered under the GST law. And with respect to exports, whether you pay tax or you do not pay the tax, it depends on you only. If you opt to make payment on the exports, you can pay the tax and export the goods. If you don't want to pay the tax on exports, you can give the guarantee or bank guarantee to the government, and you can export the goods. So, under the GST law, for the payment of taxes, you have to obtain registration. There are two kinds of registrations. One is voluntary registration. The second one is compulsory registration. Now, normally we know that we read in newspapers where the turnover of a particular dealer is less than 20 lakh rupees or 40 lakh rupees. 20 lakh rupees in respect of the sale of services, and rupees 40 lakh rupees 40 lakhs is in the case of sale of the goods. So you will get various types of dealers. One, a particular person who deals only in goods, and another person who deals only in services. Now, for these two people, the registration requirement depends on how much is the turnover of that particular person in a year. Now, the GST law says that if you are into the business of rendering the services and your turnover is more than 20 lakh rupees in a particular year, you are liable for registration. Whereas if you are carrying out the business of only sale of goods, then your turnover limit will be 40 lakh rupees. If you are a person with a turnover either less than 20 lakh rupees or less than 40 lakh rupees, the registration is not required. However, there are a number of people, in spite of these limits, say for example, Mr. A is having a turnover of only 10 lakh rupees. He is dealing either in the goods or services. His turnover per year is less than the statutory limit of 20 lakhs and 40 lakhs. Still, he can opt for registration. He can voluntarily make an application to the GST department and ask for registration, and the registration will be given to this particular person. And there may be other persons who are compulsorily required to be registered under the GST law. As I explained earlier, the turnover limit of 20 lakh rupees or 40 lakh rupees is crossed. I have crossed this limit. The moment I cross the limit of either 20 lakh rupees or 40 lakh rupees, I am liable to registered under the GST law. Number two, all the exporters and importers of the goods, they are mandatorily required to registered under the GST law. Then person liable under reverse charge mechanism. It's a mechanism where the tax is collected from the buying dealers under the GST law. So all those people who fall under the taxation under RCM method, even though their turnover is less than 20 lakh rupees or 40 lakh rupees as stated above, they are liable for compulsory registration. Then comes the casual taxable persons. Like we will get so many businesses which are like Sahara exhibitions. Almost all exhibitions, they carry out the business for a particular period of say 15 days, 10 days, 1 week, 1 month. All these temporary businesses are called as casual taxable persons. And if you are doing some exhibition in a particular place, even if your turnover is less than what is specified above, then you are compulsorily liable for registration under the GST law. So these are called as CTPs, casual taxable persons. Then e-commerce aggregator. Nowadays, it's very common for us to buy the goods and services through various e-commerce platform. All the e-commerce aggregators, irrespective of the turnover, they are liable for the registration. Then online information and data retrieval services. These services are the dealers who deal with this particular services are compulsorily liable to be registered. Then if you have any interstate turnover, irrespective of the limits, all these people are required to get themselves registered under the GST law. Therefore, you have one set of people who voluntarily registered themselves in spite of they are not compulsorily registrable, and there are certain other set of people who require compulsory registration as per the law. Now, the voluntary registration, if you have obtained from the department, say for example, your turnover is only 5 lakh rupees in a year. So many people will ask us, anyway, the limit is 20 lakh rupees. I have taken registration. My turnover is only 5 lakh rupees. Am I exempt from payment of the tax till 20 lakh rupees or 40 lakh rupees? The answer is no. The moment you obtain the voluntary registration, it means that you will adhere to the all the GST provisions as applicable to a person who is required to be compulsorily registered. There is no difference between a registration under voluntary basis and a registration under compulsory basis. The third point is, say there is a person who is compulsorily required to obtain registration but did not obtain registration in spite of having turnover 50 lakh rupees or 1 crore rupees. Now the question is, because you are not registered, are you liable to pay GST? The answer is yes. If a person is registrable under the GST law, compulsory registration is applicable, then even though that person is not registered, the GST department will recover the GST payable by him with interest and the penalties as applicable for the offences of not obtaining the registration from the GST department. Now, there are two kinds of the charges. Charge means levying of the tax. One is forward charge and the other one is reverse charge. Now, the forward charge is normal and the reverse charge is something special. So, what is this forward charge and reverse charge? We will spend a few minutes on this. Normally, when you go to a shop to buy an electronic gadget, he will say 50,000 is the price and you have to pay 18% of GST amounting to 9,000 rupees. You have to shell out 59,000 rupees to the dealer who is selling you an electronic gadget. Now, the total amount collected by that particular vendor from you, out of that 50,000 he keeps for himself and 9,000 he remits it to the government. Therefore, the situation is like this. One particular customer has purchased an electronic gadget. He has paid the price of the gadget and also he has paid extra amount of 9,000 to that dealer, and that dealer who has collected this extra 9,000 will remit that 9,000 to the government. So this concept is called as forward charge. The forward charge where the seller collects money from the customer and remits it to the government. All these transactions are forward charge transactions. In India, almost 95% of the transactions under the forward charge. Now, the next question arises is, the customer is very arrogant. He said, I will give you 50,000 rupees for the gadget what I have purchased. Why I should pay 9,000 rupees to the government? I will not pay it. Now, you as a dealer, you agree for that. You collect only 50,000 from your customer and the customer will take the gadget at only 50,000 rupees. Instead of paying 59, he paid only 50,000. Now you collected 50,000. It is your money. Now the question arises is whether the government can collect from you 9,000 rupees tax on that 50,000 of the transaction. Now the argument put forth by the seller is that the customer has not paid to me, therefore I will not pay. This argument will not be accepted by the government. It is your responsibility to pay tax on the transaction value of 50,000 rupees. However, the government has given you a right to collect that 9,000 from the customer. It is only an option given to you whether to collect from the customer the tax amount or not to collect from the customer the tax amount of 9,000. In this case, you chose not to collect from the customer means that you chose to pay out of your pocket that amount of 9,000. Therefore, whether you collect from the customer or you don't collect from the customer, it is your responsibility to pay that 9,000 rupees tax on the goods or services what you have sold to your customers, and that amount should be paid to the government. Then the forward charge may be categorized into two, B2B supplies and B2C supplies. So B2B supplies is where a business sells the goods and products to another business, and that another business either consumes those goods and services, or they further supplies those goods and services to another business or directly to the consumers. So in B2B, where one B sells to another B, that second B may sell to the third B or it may sell to C, that is the customer. Now, the second type is business to consumer. I am a business, I am a retailer. My customers are unregistered persons. Those are called as consumers or customers. So B is another business. C is the consumers. Therefore, the forward charge takes in two forms. One, the business selling goods to businesses, the business selling goods to consumers. Now, the point is whether you sell to businesses or whether you sell to consumers, the responsibility will be there on you, make payment of taxes to the government. The second type of charge is reverse charge. So here normally we say that wherever the government is not able to collect the taxes from the businesses, they will go to this reverse charge mechanism. Now, number one, import of goods and services. When I import the goods or services from a supplier who is outside India, Now, the point is the seller is outside India and the buyer is inside India. Now, for the government, it cannot go to the other country and levy tax on the seller of the goods. In the previous screen, you saw forward charge. Forward charge is a charge of tax by the government on the seller of the goods. Now, here in the case of import of goods and services, the seller of the goods and services is sitting outside India. The government has no power, no authority to ask the person who is sitting outside India because he is outside my taxable territory. I cannot ask him pay the GST in India. Therefore, the government will resort to the method of taxing the recipient of the goods and services, that is the buyer of the goods and services. The moment the goods and services are imported from outside India, the government will collect GST, which should have been paid by the seller, which could not be collected by the government. Now the same tax will be recovered from the buyer as if he is the seller of the goods and services. Therefore, the moment goods are imported into India, the goods has to be cleared for home consumption by paying the GST applicable rates under the reverse charge mechanism. The second very most popular category under RCM is goods transport agency. I remember during the service tax regime, the service tax was levied under forward charge on goods transport agencies. What they did was they stopped all their services for 15 days to 1 month, and the price of the tomato went to 300 rupees per kg. And the people started protesting against the government for increase in the prices. Immediately, the government negotiated with the goods transport agencies and they withdrew the levy of the service tax on GTA services. However, the mind of the government to recover the tax from GTA was there. Therefore, what they made was in the service tax regime itself, they said, you are the goods or transport agency service provider. Don't pay me any tax. I will catch hold of goods transport agency service buyer, receiver. So, under the reverse charge mechanism, the service tax levied in that day itself. Now it has been continued in the GST regime also, where a particular person who receives a GTA services from the GTA service provider, the tax will be discharged by the buyer of the services and not by the seller of the services. Therefore, this GTA services has been moved out of forward charge and brought into reverse charge. However, in the recent past, they have allowed the goods transport agencies to pay tax on forward basis also. It is an option given to them. It is not compulsory. If they want, they can remain under the forward charge. If they don't want, they are out of the forward charge, and the reverse charge is applicable on the buyers of the services. Then the renting of immovable properties from the 1st of October 2024, from this month onwards, the RCM on immovable properties is made applicable. We see a number of businesses who are carrying on their businesses in rented premises. The rented premises, a number of cases are owned by small individuals, and the total rental amount does not exceed 20 lakh rupees. Therefore, they are out of the GST net as their turnover limit of 20 lakh rupees they have not crossed. Assume a case where a commercial property is given on rental basis at 1 lakh rupees per month. The total rent for the year is 12 lakh rupees. Under the GST law, sale of services till 20 lakh rupees, the registration is voluntary. Therefore, in this case, as the turnover is less than 20 lakh rupees, that is the rent received is only 12 lakh rupees, that person did not get registration under the GST law. So the landlord rendering the service of renting of immobile property to the businessman, The businessman is buying the rental services from the owner. The value of the services purchased is 12 lakh rupees. Now, from this month onwards, those businesses who have obtained immovable properties from a person who is unregistered URP, then this has been brought under reverse charge mechanism, and every businesses now they have to discharge 18% GST on the rental services. So this is one area. The second one is the businesses sometimes they obtain residential houses on rental basis. Now, there are two categories of businesses. There are two kinds of purposes for which a business entity will obtain the residential properties. So, for example, the taxable person is an individual businessman, say, for example, Mr. X. Now, he has obtained registration under the GST law. He is carrying out the business of a TV showroom. On the TVs sold, he will discharge the GST. Now, he has obtained a residential house property for his residential purposes. He is living in that rental house. Now, in this case, the GST is not leviable on Mr. X under reverse charge mechanism because the registered person uses this particular property for his residential purposes, for his own residential purposes. Therefore, the residential property in the case of Mr. X has been kept outside the purview of the reverse charge mechanism. However, if there is a company which obtains a residential house from unregistered person and gives this particular house as quarters to its employees, staff quarters, then the nature of the transaction is that the company has obtained the residential house not for its own residence but for the residence of its employees. Therefore, the residential house property is used for the purpose of the business, not for the purpose of own residence. Therefore, even in the case of the companies, the residential properties and commercial properties obtained from unregistered persons on rental basis are liable to GST under the reverse charge mechanism. However, a point to be noted is the tax paid under reverse charge mechanism is available as a credit to discharge the output tax liability of that particular registered person. However, the catch is when you are a business, registered business, carrying out the most of your transactions, say 98% of your transaction is exempt supply, only 2% is taxable supply, then the tax paid under reverse charge mechanism will become a cost to you. You cannot claim the credit for ITC you paid under reverse charge mechanism because the majority of the turnover of yours is untaxed under the GST law. Remember, the ITC can be deducted, can be taken credit only when your outward supply is fully taxable. If you are rendering any services or if you are selling any goods which are exempt in a property which is taken on rental basis, the ITC is restricted in respect of tax paid under reverse charge basis. And also there are a number of agricultural producers which are kept under reverse charge mechanism where you buy from agriculturists certain products. One of them is raw cotton. You have to discharge the tax liability on the raw cotton on reverse charge basis. However, the credit is available when you sell the cotton to either B2B or B2C. Then I want to highlight the next concept of mixed supply and composite supply. When you supply the goods, you can categorize them as an individual supply or a mixed supply or a composite supply. Say for example, when you sell a pen, it is an individual product. When you sell two or more goods or two or more supplies as a bunch, as a bundle, it will fall under either mixed supply or a composite supply. Now, the whether a supply is a mixed supply or whether a supply is a composite supply determines the tax rate applicable in respect of this particular supply. When you go to a mall, you will see a number of the bundled products. So when I went to one of the malls, I saw one bucket in which there was 1 kg sugar, 1 kg dal, 1 liter oil, then 1 kg of potatoes, all put together. The entire bucket was sold at 1000 rupees. Now, it is not a single supply. It is a supply of various products. One is bucket, sugar, dal, rice, oil, etc., etc. So many supplies included in one supply, and a single price is charged for that. He will not say rice is this much, bucket is this much, and oil is this much. No segregation. In total, a sum of 1000 rupees is charged for that product. Now, you have to look into the composition of the products inside that bucket. Now, the composite supply is a concept where I'll give an example. If you go to a restaurant, you will order for idli. Idli comes along with chutney and sambar. So the supply, there are three supplies in this particular supply. One is idli, the other one is chutney, and the other one is sambar. So all these three are naturally bundled. Whenever you say idli, it has to come with either chutney or sambar or both. It is called as composite supply. Whereas the example what I gave, in a bucket, there is a sugar, there is a oil. So this kind of mix is not a naturally bundled. Therefore, it is called as mixed supply. Now, the tax rate you have to determine based on whether that supply is a mixed supply or a composite supply. In the case of mixed supply, the rate of tax applicable on entire supply is the highest rate of a product in the bundle. The highest rate applicable for one product in the bundle is the tax rate for entire 1000. Whereas in the case of idli, chutney, and sambar, the principal supply is idli. Therefore, the tax rate applicable for idli will be levied for that entire supply, that is composite supply. So this is very important for the purpose of determining the rate of tax applicable in the case of bundled products. Then the the next concept is in the case of manufacturers, traders, restaurants, and service providers, you have an option to pay the tax under composition method. Tax under composition method. So for manufacturers and traders, you can go for this method of taxing, and for restaurants and service providers also you can go for composition tax. Now, we have to understand what is the regular tax and what is the composition tax. I will give you two examples. One, you are a dealer in television. You will go to the market, purchase a TV by paying 1 lakh rupees plus 18% GST on that. Your purchase price will be 1,18,000 including the GST of 18,000 rupees. The same TV you will bring to the showroom, keep it there. The customer comes, you sell the product at 2 lakh rupees plus GST. Now, you will sell the product to the consumer at 2 lakh rupees, and also you will charge 36,000 rupees as tax, and you will collect that 36,000. Now, you have two transactions. One is inward transaction, one is outward transaction. You are liable to pay to the government the tax on your outward transaction, 18% of 2 lakh rupees, which amounts to 36,000 rupees From this 36,000, you can deduct 18,000 rupees while making payment to the government. Therefore, 36,000 minus 18,000 ITC credit, you will pay net amount to the government, only 18,000 rupees. This is a regular method of taxation. Find out what is the tax payable on your sales. Deduct what are the taxes paid on your purchases. The net amount make it to the government. This is called as regular method of taxing the goods and services. The second method is composition scheme of taxation. In the composition scheme of taxation, the amount of turnover in the case of the manufacturers and traders, it is a maximum 1.5 crore rupees. If your turnover is less than 1.5 crore rupees, you can opt for this scheme. Restaurants, there is no turnover limit. For service providers, there is a 50 lakh rupees of turnover limit. Now, if you are a manufacturer and trader, say in the same example, you are a buyer and seller of TV, you purchased a TV for 1 lakh rupees and paid 18,000 rupees GST on that, and you are going to sell the TV at 2 lakh rupees. Now, you have to charge only 2 lakh rupees to the customer. You cannot add GST on the sale value because you have opted for composition method of taxation. So you are not allowed to collect taxes from your customers. Number one. Number two, from your pocket, you have to pay the specified rate of tax under composition, normally which will be 1% of the sales turnover. Therefore, the method of calculation of the tax is like this. You have purchased the goods by paying 1,18,000 rupees. You will not get credit of that 18,000 taxes what you have paid to that dealer. And over and above that, on the value of the goods sold by you, you have to pay a fixed percentage as tax to the government. That too you have to pay out of your pocket. You cannot collect from your customer. Then, in the case of restaurant, there is no limit of turnover. Any n amount of turnover you can do, and you have to pay 5% of the turnover, and service providers will pay 6% of the turnover, and no dealer who is under this composition scheme are eligible to take credit of the input tax credit on the purchases made by them from the registered persons. So inward supplies ITC, the tax paid, it becomes the cost for you. So this one thing you have to keep in mind in the case of composition type of taxes. Then the very important concept is the place of supply. So the tax is dependent on the place of supply, where the supply has happened. I will give you 2, 3 examples. Number one, I am sitting in Mysore and I am selling one television to my customer who is in Chennai. So I will raise an invoice on my customer who is in Chennai for 1 lakh rupees plus 18% GST. 1,18,000 is the invoice amount, and I will pack the goods and send it through a transporter to the Chennai address of the customer. Now, in this transaction, only two parties are involved. One is the seller, the other one is the buyer. The seller is in one state, the buyer is in another state. Invariably, this transaction is interstate supply. Why? Because the place of supply in this case is Chennai, because the address of my customer is in Chennai. The place of customer is in Chennai. The address of the customer is Chennai. The goods are going to Chennai. Chennai is the place of supply. Therefore, Tamil Nadu is the place of supply. Supply is done from Karnataka. Therefore, two states are involved. Therefore, it is called as interstate supply, where the GST leviable is IGST. This is one example. The second example, I am sitting in Mysore. I am a computer dealer, and I have one customer in Mysore itself, and he want to donate some computers to an ashram in Chennai. Now, three parties are involved. One seller of the goods, the second one is buyer of the goods, the third one is the person who receives the goods. In my example, the buyer of the computers, he want to donate the computers to the Chennai ashram. Therefore, he comes to me, pays the money 1,18,000 and ask me to deliver the goods to Chennai ashram. Now, the invoice, the bill for the supply is done by Karnataka man to the customer Karnataka man, whereas the goods are moving from Mysore to Chennai. Now the question arises, what is the place of supply? The rule says the place of supply is the place of customer or the address of the customer. For me, the customer is not the ashram of Chennai. The customer is another person who is sitting in my place itself, Mysore. Therefore, a person in Mysore selling to another person in Mysore, it becomes intrastate. The place of supply is Karnataka. Therefore, Karnataka dealer selling the goods to Karnataka buyer. Therefore, there is intrastate supply even though the goods moves out from one state to another state. Then there are certain exceptions for this, where one of the examples is the immovable property. If the immovable property is in a particular state, say for example, I will take an example for this. I am the owner of a chowltree in Chennai. I am a person in Mysore, and the marriage is being conducted by a person who is sitting in Rajasthan. So the supplier of services in Mysore, the recipient of services in Rajasthan, the event is happening in the immovable property situated in Chennai. Now, the place of supply is Chennai, and under the GST law, the place of supplier is also deemed to be Chennai. In the case of immovable property, both the place of supply and place of supplier both are Chennai only. Even though I am sitting in Mysore, that will not be recognized as the place of the supplier. The Chennai itself, the property where it is situated, that place itself is deemed to be the place of the supplier, and the place of supply is also that immovable property. Therefore, it becomes an intrastate supply, even though the renting of that chowltree is given by me to a consumer customer in Rajasthan. So, the person who gives the property on rent and the person who takes the property on rent, both are sitting in different states. In spite of that, the place of supply and place of supplier will be the Chennai, and the intra-state taxes, that is the central GST and state GST, will be levied on those supplies. Then the next concept is time of supply. So here we have two categories. One is supply of the goods and the supply of services. The time of supply of the goods, when is the goods are supplied? That is the time when you have to pay the tax on the goods supplied. Number one, the invoice rules says that the invoice in respect of goods shall be issued before the goods start movement. Therefore, if you are selling the goods and the goods have started movement, before that you have to raise the invoice. The moment you raise the invoice, it means that you have sold the goods, and that is the date when you will become liable to pay the taxes. Therefore, the invoice is the key for ascertaining when the supply is made to another person. Once the supply is made at a particular point of time, then the tax is leviable on that particular point of time. Say, for example, if you raise an invoice on 31st of the March, the tax will be paid during that month. If you raise an invoice in the first of next month, the tax will be paid on the first of next month. This is the time of supply for goods. Whereas in the case of provision of supply, there is a facility. given by the GST law to raise invoice either before the provision of supply or on completion of the provision of supply or after the service is provided. So we have three timelines. One, if the invoice for the service is issued before rendering the service, then invoice date will be the time of supply. So for example, I'm a chartered accountant. I get an order to audit the accounts of a company, which I'm going to do it next month. However, I raise the invoice during this month itself. The time of supply is this month. I am supposed to discharge my tax liability during this month. The second method is once the audit report is handed over to the client on the same day, I will raise, means the invoice is raised on the day when I completed the service. So that is the time when the service is provided, and that is the time when I have to pay the GST. And also the third scenario is I got an order, then I executed the order, I conducted the audit, and then gave the report to the client, and I have got 30 days from the date of completion of service to issue the invoice. If I issue the invoice on 28th day or 29th day, my time of supply will be that date when I issue the invoice. However, if I issue invoice after 30 days of rendering the service, then date of completion of service will be the date when I am supposed to pay GST. Say for example, I completed audit on 15th of July. If I raise invoice before 15th of August, then I will be paying the taxes in the month of August. If I raise invoice on the 20th of August, which is after 30 days from the completion of the service, then I have to discharge my tax liability in the month of July itself. And also, please remember, if the consideration for rendering of services is received before rendering of the services, then irrespective of the invoice and irrespective of when the service was completed, I have to pay GST on the services for which I have received money consideration in advance. So this is the rule regarding the time of supply in the case of the services. Then input tax credit. So you know that the main advantage as promoted by the government is to remove the cascading effect of taxes paid, which is very true to certain extent. Not 100% cascading effect has been removed. Now, what is input tax credit? So, it is a credit for the taxes paid by me to my suppliers in respect of inward supply of goods and services which are used by me for outward supply of goods or services, or the goods and services which I received from the vendors. I'm going to use them in my business. I will give you two examples. I am a person who is dealing in televisions. My business is purchase the televisions and sell the televisions. Now, when I purchase the television, I will pay GST to the vendor. When I sell the television, I will pay GST to the government. So the GST payable on the sale is 18%. That amount I need not pay full. The amount which I have paid to my vendors at the time of purchase of the goods, I can deduct from the amount of tax payable on my sales, and the net amount I am going to pay to the government. It is called as input tax credit. However, this is when I buy the goods for the purpose of outward supply. The inward goods are used for the purpose of outward supply. There are certain other inward goods and services which I am not directly selling it out. Say, for example, the stationery items purchased by me is going to be used in my office. So I am buying the stationery. When I buy the stationery, I am paying the GST on that. But unlike the televisions, I am not going to sell these stationery items. They get consumed during the course of carrying out my business. Now the question is, from the tax payable on the sale of my TVs, say for example, 2 lakh rupees is the sale of TV amount, 18% is the tax rate, 36,000 rupees is the outward supply tax payable by me, output tax payable by me, against which I have paid 18,000 to the vendor who supplied the TVs. Therefore, 36,000 minus 18,000, the net tax payable is 18,000. Assume there are some other inward supplies like printing and stationery, then audit fees, rental, etc., on which I have paid a tax of say another 3,000 rupees to those suppliers. Now, my liability, net liability will be 36,000 minus 8,000 minus 3,000. So out of 36, 21 will be deducted and remaining only that much amount will be paid to the government. Now, the deductions what I make from the tax payable, there are two components. One, the ITC on TVs which were directly sold. Number two, ITC on inward supplies of printing and stationery, etc., which are not directly sold by me, but they are used during the course of carrying out my business. That also I can claim as ITC, which was not there in the earlier tax laws. So to this extent, it has been streamlined, cascading effect has been removed. Then the common credit. So the common credit is the concept of common credit is like this. Now you are selling two products, product A and product B. The turnover of product A is 1 lakh rupees. Turnover of product B is 1 lakh rupees. Say total turnover is 2 lakh, 50-50, taxable and non-taxable. Now, the common credit is inward supply, which is commonly used for both outward supply of taxable goods and outward supply of non-taxable or exempt goods. Say, for example, you have a showroom for which you are paying a rent of 1 lakh rupees, on which the landlord charges you 18,000 rupees tax, which becomes ITC for you. Now, this particular building you are using for selling the taxable supplies as well as exempt supplies. Now, the credit what you get, the ITC what you get is common for both the taxable supplies and non-taxable supplies. Now, the government says the common credit which is attributable to taxable sale only should be claimed by the taxable person. In my example, the total turnover is 2 lakh rupees. Taxable is 50%, non-taxable is 50%. Therefore, common credit 50% is allowed to you. Remaining 50% of credit, common credit, is not allowed to you. It becomes a cost for you. So, this is the concept of common credit. Then this common credit should be proportionately computed month by month and should be reported and reversed during filing of your GST returns. Then the next concept is blocked credit. Blocked credit means you have a number of inward supplies which are listed under the blocked credit under section 17. Section 17 provides you a number of transactions where even if you have paid the taxes at the time of inward supply, purchase of goods and services, that credit, the amount of tax paid during that purchase, is not allowed to you to set off from the payment of the outward supply. Examples are the motor car, the motor vehicle which can carry less than 13 people, and say for example every GST dealers we will buy one car either for personal use or for the business use. The GST paid 28% plus 17% cess, 45% GST paid. It is not allowed because it is blocked. Then Input tax credit is allowed when you purchase the goods. Now, the purchases can be categorized into two. One is cash purchase and the credit purchase. Cash purchase means on the one hand, you will receive the goods. On the other hand, you will pay the cash to the vendor. In credit purchase, first we will receive the goods and the payment will be made later. Now, where you have purchased the goods either on cash basis or credit basis, in the month in which you make the purchases, you are allowed ITC on those inward supplies. However, the law says that the credit purchases what you have made, for those vendors, you have to make payment within 180 days of from the date of invoice. There is a condition. If you do not pay to the vendors within 180 days as specified by the GST law, on 181st day, the ITC what you availed on the date of purchase of the goods, you have to give it back to the government. You have to pay it back to the government along with interest from the date of purchase to the date when you make payment to the government. The simple thing is that if you are regular in making payments to the vendors, there is no issue in respect of the credit allowed to you. However, if the payment is not made within 180 days, then the credit what you enjoyed in the month of purchase has to be given back to the government with interest. And suppose if you make the payment to the vendor in the 200th day, then you are allowed to reclaim that particular credit of ITC what you gave in the 181st day to the government. You can take it back from the government and take a credit for discharging your outward supply liability. However, remember the interest paid while reversing the credit, giving back credit to the government, the interest paid to the government, it's gone. You will not get back the interest paid to the government. Then your input tax credit, your entitlement to input tax credit depends on various factors. Number one, you should have an original tax invoice with you. It is like you are having original sale deed for your property. Same way, if you buy the goods or services, you should have the original document called as tax invoice. Number two, the goods or services mentioned in the tax invoice should have been received by you. So the first condition is you should have a original tax invoice. Number two, you should have received the goods and services. It is with you. Then the tax charged in the purchase bill has been paid by that vendor to the government. If the vendor collects a tax from you and does not pay to the government, you cannot take the credit. Number four, the amount of the credit should be reflected in a form called as GSTR 2B. Now, this is a mechanism where you can find out whether the vendor has paid tax to the government or not. So, whenever a vendor reports the sales made to you in his form, that will appear in the purchaser's form called as GSTR number 2B. He can see that particular transaction in GSTR 2B, then he can decide to claim the ITC. Then to claim the ITC, the buyer has to file the monthly return. In the monthly return, he has to claim the taxes paid by you to the vendor. In turn, vendor has deposited tax to the government will not automatically give you the credit. You have to claim the credit through your monthly return, which is being filed in the form GSTR 3B. If you miss out to claim in your GSTR 3B, the credit is not available during that particular month. However, you can claim it in the next month by making an entry in the GSTR 3B. Then this we have already discussed. Then We will talk about some ledgers, cash ledger, credit ledger, and liability ledger. Now, this ledger is like a bank account. You have your bank account. Whenever you deposit money into bank, in your passbook, it comes in the credit side of the passbook. Whenever you withdraw the money, it will be there in the debit side of the passbook. So your cash ledger is just like your passbook. Then your credit ledger is also another passbook where the amount deposited will be written by you only. In the cash ledger, when you make a cash payment to the government through electronic mode from your bank account, the money goes to the cash ledger. When you pay tax to your buyer and you enter the same amount of tax in your monthly return, the amount of tax paid by you will be credited to the electronic credit ledger. This is one more bank account for you. The amount gets in the credit side of that passbook. Then liability ledger is like your car loan. Assume that in a bank you have two SB accounts and one car loan account. So cash ledger, credit ledger are just like your bank accounts, and liability ledger is like your car loan account. Now, the every month you have to pay EMI in your car loan. Now what you have to do, every month you have to go to either passbook number 1 or passbook number 2 and transfer money to the car loan account, which you have to do it manually. The same concept is applicable in the case of cash ledger, credit ledger, and liability ledger. Now, cash ledger is my account with the GST department. Credit ledger is my account with the GST department. My money is sitting in cash ledger. My money is sitting in credit ledger. Whereas liability ledger is just like a loan account where I have to pay the taxes on my sales. The tax payable on my sales is like a loan payable to the government. Now, every month, 20th is the last day to pay the taxes. Whatever taxes payable by you should be paid on 28th, that is the last date. So you have to manually transfer funds from either cash ledger or credit ledger, whichever ledger you want to use, you can use it. From these two bank passbooks, you have to transfer money to the liability ledger so that that liability gets 0. Now, if you delay in transferring the money from cash ledger and credit ledger to the liability ledger, even by 1 day, you have to pay interest for 1 day. You may argue that my money was already there in my cash ledger on 20th of this month. But the transfer I made on the 21st of the month, 1 day I have delayed, but money was with you only. Even still, I have to pay the interest on this particular delay. The money was with you. My fault is delay in transferring that money from one ledger to another ledger. Still, I will be liable to pay interest. However, luckily, right now, the money lying on the credit ledger, to that extent, I need not pay any interest. However, if the payment is made from cash ledger, that amount, that portion of the amount which is paid towards a liability ledger is liable to be interest. The interest has to be paid. That e-way bill. E-way bill is a concept where the government don't want any transaction to be escaped from the taxes. Now the statutory limit fixed for this purpose is 50,000 rupees. The concept is very simple. Before you start movement, the government says, the GST department says, before you start the movement of the goods, come to me and write that you are going to sell this much worth of goods, this particular person, and the address and GST number of that particular person is this. You come to my portal and record this particular transaction. I will give you one ticket, like it's like an entry ticket to an event. So I will give you a ticket called as e-way bill. Now, whenever you move goods from one place to another, the invoice value of which is more than 50,000 rupees, you have to invariably carry this e-way bill along with the goods. If you do not create this e-way bill on the portal of the government, there is all possibility that the value of the goods are transported from one place to another. You may delete from your ledger, and there is all possibility that you may not pay the GST. That is why the government has made it mandatory for every transportation of goods more than 50,000 to be noted in the e-way bill portal of the GST department, and you have to raise an e-way bill document, and that document should be there along with the goods which are being moved from one place to another. Now, what happens if there is no valid e-way bill? Then you are liable to pay penalty equal to 200% of the tax leviable on that particular goods. Say, for example, 10 lakh rupees is the goods on which 18% is the tax amount. 1,80,000 is the tax involved. If you don't have an e-way bill, then 200% of the 1,80,000, 3,60,000 penalty you should pay to the government, and then you have to move the goods further. This happens when some tax people will come on your way and stop you and ask for e-way bill. If you don't have e-way bill, you end up paying 3,60,000 as penalty, which will not be refunded to you. So this is a very consequential amount involved in this. Then e-invoicing. So earlier what we saw was e-way bill. Way bill means on the way of transportation of goods, this bill has to be produced, this document has to be produced. Whereas e-invoicing is a method where every invoice raised by a dealer on another business. It is right now it is applicable only to B2B transactions, and all those invoices raised by me should be uploaded on the GST portal. There is a separate portal for e-invoicing. You have to report that invoice to the e-invoicing portal. The e-invoicing portal will capture the data, and it will give an internal reference number to you. That internal reference number should be printed on the invoice, but also a QR code will be generated, and the e-invoicing portal will throw you your invoice. So you input your own invoice, it will come back to you with some additional information, like one is QR code, the other one is IRN number. Now, every registered person whose turnover is more than 5 crore rupees in a year is compulsorily do the e-invoicing. If a trader or if a B2B person purchases from this particular dealer who is required to generate e-invoice, but he does not generate e-invoice, then there is a problem for the buyer. The problem is he will not get the credit for the goods purchased. Therefore, every buyer should verify that the goods received with an invoice. He has to check whether that invoice should be an e-invoice or normal invoice. The person whose turnover is more than 5 crore rupees is mandated to issue e-invoice. If he issues a normal invoice, not an e-invoice, then the buyer will not get the credit for the taxes paid on purchase of the goods. Then every dealer is required to report information to the GST portal. So normally every month the person will be filing the report of the sales on the 11th day of the month, and on the 20th day of the month he will report his liability by calculating what is the tax payable on sales minus what is the tax paid at the time of inward supply. The net tax he has to report in GST or 3B. These two forms are filed by every registered person every month. And also the GST department will provide you a form called as GSTR 2B, wherein it will give you the details of invoices for which you are eligible for credit. By looking at the invoices, purchase invoices in 2B, you can find out how much ITC you are eligible. And also, once in a year, every dealer has to file one annual return if his turnover is more than 2 crore rupees in a year, and also 9C if his turnover is more than 5 crore rupees in a year. These are the very common, very popular reporting requirements. Apart from so many other requirements are to be done on need based. Then the government may recover from you the ITC which you enjoyed earlier. So what happens in one of the cases, it so happened that I received a purchase invoice, I received the goods, everything was right, but that vendor did not pay taxes to the government. Now, the GST department straight away came to the buyer and said that seller has not paid the taxes to the government. Therefore, the ITC claimed by you is erroneous. You refund it along with interest and penalty. They made a demand on this particular party. Then the case went to Madras High Court, wherein it was decided that before going to the purchaser for the recovery of the taxes which are not received by the government, an effort should be made to recover the taxes from the seller. The GST department never bothered to ask the seller who collected the taxes from me to make over it to the government, but instead they straight away came to the buyer and demanded the ITC enjoyed. So the Madras High Court categorically said that first you try all your this thing on the seller. If you are not able to, then you come to the buyer. Then the blocked credit, the most important item is in respect of ITC on immovable property. For the used for the construction, you will have steel, cement, bricks, etc. All those materials which are used for the construction of immovable property or ITC paid with respect to payment to contractors was blocked. Recently, Supreme Court held that such blocking of ITC is constitutionally valid, and the GST department has won the case. Now, every person who have some ITC in respect to immovable property, they have to reverse this ITC. They cannot claim this particular item. Then one more issue is the normal waste during the course of manufacturing. The rule for ITC is that if certain goods which are being used for outward supply gets lost, then the ITC on the lost goods should be reversed. That is the rule. But the GST department started using this against normal waste, production waste, and again, Madras High Court, in the case of ARS Steel case, held that normal wastage is inherent in the manufacturing process. Therefore, the ITC on the goods lost during the process of manufacturing should not be demanded from the users of those particular goods. Then the question arose in the case of evasion of GST, the GST department will raid the premises and they will seize the goods, accounts, records, etc. And also one officer seized the cash available in the cash box also. And this case went to the Delhi High Court. Delhi High Court said that the subject matter of cash with the dealer is not liable to be seized by the GST authority. Therefore, they can seize the goods, they can seize the accounts and documents, but not the cash. Then the ITC, if wrongly availed, the interest is payable under Section 50. The rate of interest is 18%, 1.5% per month. The market rate of interest will be 8, 9, 10%, whereas the government is charging 18%. No interest is payable if ITC is availed but not utilized. ITC I have taken to my credit ledger, but I have not transferred to my liability ledger. Then the interest is not leviable as decided by the Madras High Court in one of the cases. Then online gaming industries, casinos, etc., the tax rate is 28% because the service is a sin service. Now, recently in the year 2023, the government came out saying that the 28% tax is applicable on the gross amount collected from the customers. Now, in the case of Delta Corp, the market capitalization is 3,262 crores, whereas the demand raised against them is 20,000 crores. If this case uh, is lost by the Delta Corp in the it's there in the court. If it loses the case, then it has to be dissolved. Such a tremendous pressure is there on the online gaming industry. So these are the things what I wanted to share with you as an overview of the various concepts under the GST law. Thank you very much for patient viewing